Well, thanks so much for tuning into the Talking Point version today. And it was important to do yet another Talking Point conversation today, simply because of the nature of the market. And therefore, we thought we get somebody who kind of has seen multiple such cycles. Maybe this is very different than the others, but that's the question to Andrew Holland today, as to whether this is different than the others that we've seen in the past, part one, and whether this narrative of buy the dips because 1 year from now the markets will be higher, does it actually make sense, or is it prudent to actually be on the sidelines considering the uncertainty surrounding us? Andrew, great having you. Thanks for joining in. It's a difficult time as a money manager, I'm sure. So thank you for taking the time out.
Always my pleasure. Always my pleasure.
So Andrew, the most simple narrative that I heard since day one of this war is that people, relationship managers and some of the others sending out messages that I'm being brave in the wake of this war because I'm looking at the markets 2 years out and I'm putting in money. Are you? I mean, that was the most common message that I got, not verbatim, but something like this. My question is it as simple as doing that there's a dip, go out and buy, because the markets in the last 24 months have shown the template that every dip is getting bought into?
No, that's correct, and I'm not saying that won't work at some point. But I think, as you use the words brave, I think it would be brave at the moment. And whilst I'm saying it's not that easy to kind of say, is it similar to similar problems before? Because I think this time around, there's one big difference to my mind: is the economic war which we're waging with Russia. And I don't think you've really seen that. You've seen sanctions, but you haven't really seen an economic war where you've gone after their foreign reserves, and companies are moving out wholesale now and stop doing trade. So that's the big difference. And of course, Russia and Ukraine, between them, have quite large exports of wheat and corn. So that's the other area, is food. We all look at oil, but food prices are also rising very quickly. So I think at the moment, I think everyone was not hoping, because that's the wrong word, but everyone was expecting maybe that Kiev would have been, kind of taken over could have invaded and taken over by the Russians by now, but it seems to be more prolonged. Now, if you get something that's more prolonged, the risk is that, each side ups the rhetoric or ups the ante to try and cause a little bit more pain. And that's what we're seeing at the moment. And that's what worries the markets. You're on mute.
Yeah, Andrew, sorry. So therefore, Andrew, the simple question, the template cannot be as simple as go out and buy the dip, because the underlying economic scenario for a country like India as well has changed considerably, with crude being where it is. Even if it doesn't stay at 130, but if crude at 100, 110, it's still nasty compared to crude at maybe 70, right?
So I'll come back to India at the end, but what it means for Europe in particular is that, at best, Europe will have stagflation, but it's looking more and more likely that it's going to fall into recession. With oil prices where they are, I think stagflation is something that you could really talk about now in the US. Now, markets doesn't like any of those two scenarios, stagflation or recession. So that's what they've got to grapple with. How long will the conflict continue, and how much damage will it have, to the global economy? Now, for India, obviously, fiscal deficit, interest rates will have to rise in India. That's for sure. Otherwise, the currency will head towards 80 very quickly. And that in itself brings in inflation, right? Because you're depreciating currency and so forth. So why have foreigners continued to sell? Because anyway, from October onwards, they were expecting interest rate hikes in the US. And when that happens, we spoke about this before, they tend to sell emerging market assets, whether it's currencies or markets and so forth. Now, with this high inflation and growth concerns, then obviously, everyone's just taking risk off the table. Safe haven is obviously dollar and the Swiss franc at the moment, and that's about it, because everywhere else in the world is going to be hurt by higher oil prices. Even though prices in the US are rising, they do have a large supply, so they can look after themselves to some extent.
Andrew, is this your fear of yours of stagflation at best and a recession in the most likely event? Let's put it that way, or recession also likely. Let me not put words in your mouth. But that narrative or that belief, is it now a near certainty, even if the conflict were to end in the next few days? Has the damage already been done?
So let me take the two sides. Let's say it continues a little bit longer than we expected. Then what will happen at some point, the increase in commodity prices and food prices will have a demand destruction element to it as well. Because obviously, if you're sat in, say, the UK, and you've got £100 as your disposable income, half of that might be going down to new energy bills or food prices. So you'll have less disposable income, therefore demand generally for products and services will start to fall. So it will bring commodity prices down at some point, and that's probably why recession is first and then commodity prices fall. So I'm a little less worried about that in the kind of longer term. But I think if things were to normalize, when I say normalize, there's some kind of ceasefire, then there's two things that will happen. One, commodity prices will fall, obviously. And then if it's a ceasefire where trade starts to happen, sanctions move away, then obviously we will start to see that supply chain start to improve again, and therefore again prices will fall. But the fact is that you've still got to tackle inflation. It's not going away. So you'll go to the next phase, which is the interest rate environment globally. And the Fed have already said 25 basis points. I suspect if you had a ceasefire tomorrow, they'd do 50, just to get things under control and get things moving. So, but I think the market will rejoice that in some respects. And on a more optimistic view, if your scenario came true, then there's a few things that I think, two or three big trends which will happen. Governments will do what? They'll look at their foreign reserves and say, we don't want to fall into this trap, in any future date. So should we be having dollar-based assets like the US dollar? So will it mean to a lower depreciating dollar over time? I'm not saying everyone's going to sell their US dollars tomorrow. Second, governments and companies are going to say, what is our supply what's the problems with any supply going forward? So if you think about it, you'd naturally say, should I be buying semiconductors from Taiwan at the moment, given there's a risk of China's intentions there? So you're going to start to look and say, we need to have more of this in our own country, right? You've seen it with Germany, defense spending starting. Renewables is going to be the next big area because of the oil price and gas prices. Therefore, everyone's going to look at where do we have a gap in our supplies, so that we can start filling at home. So the capital expenditure from each of the countries towards these areas could be very, very significant. And that will lead GDP growth going forward.
That will also be very inflationary over medium term, Andrew, since the lowest cost producer goes out of the equation partly, if not wholly.
Yeah, so you're saying it could be, but it's not going to happen. No one's going to start spending straight away. So commodity prices first would fall under your scenario of ceasefire, get back to normal supplies, no sanctions. And then you'll start to see companies and particularly governments saying, like we are doing, semiconductors in India, we don't have. We need to invest more. We need to give incentives to do more in these areas. So that will lead to I believe, a company capex cycle to fill in those gaps going forward.
Andrew, there are bets being placed on. I'm not asking for levels, by the way. I'm just trying to understand the scenarios. There are bets being placed on the Nifty now reaching 15K or even lower. And the belief is that forget the war situation, but the inflation stroke lower growth numbers, plus the damage on the fisc and other factors lead to a natural southwards move, even if there were to be some ceasefire in the course of the next couple of weeks, would you believe that it is prudent to sit on the sidelines for the time being until the situation settles down? Or are you buying the dip, even if you're going micro and not macro, because valuations in some of the places could be looking maybe attractive?
Yeah, and you're right. It's very tempting, right, to dip your toes. But we're going to sit on cash. I mean, we have been doing for some time now. The scenarios we talked about from worst case to the best case, it's too fast changing for my liking. So you can be whipsawed both sides. So listen, sitting on the side, letting things come to some conclusion, hopefully somewhere, gives you that kind of confidence to say, okay, I think I know why I'm going into the market, and it's the companies that I like. So I got my shopping list ready. But the question is this: is that if I do it too early, I just get whipsawed. So I can sit. If I miss the first 5% of a share price rise, it's okay, right? And in the longer term rise going forward, and I think that's what I would do. But what I was trying to emphasize to you, Niraj, is that maybe, if the optimistic scenario plays out, it will be different sectors of the economy which do well and will lead the market higher. Not that, listen, if it's ceasefire tomorrow, Nifty goes up, everything goes up with it, right? All go financials. But I think once the dust settles again, then I think we're saying, okay, if I was in Europe, I'd be buying defense companies, not just because it's a safety, it's a safety in terms of earnings and so forth, but I know there's going to be huge growth.
Yeah.
Now, that might play against ESG type investing, but I suspect that will change. I suspect a lot of things will change after this.
Yeah, and to have you kind of try to think around what could change in India, if at all. India is not at the forefront of the conflict, if anything, kind of far removed from the epicenter of the conflict in many ways, but it does get impacted because of the second order effects, because of commodity prices, etc. When the dust does settle down, looking at the idiosyncratic factors and the global factors put together, do you reckon a change in themes, in other factors will come into play for India as well?
Yeah, I definitely think, I mean, renewables, the kind of move towards renewables, I think will accelerate, not just in India, but globally. Obviously, defense spending, and whether India can play some part in that for companies, so for governments going forward as well. But I think that the big move will be in electric vehicles, it will be in digitization. All of these will continue to rise, but there'll be certain industries that India as a government will look at and say, we don't have, we're reliant on everyone else in the world. Forget oil for a second, but semiconductors are doing something. Where are the areas that India would really need to fill those gaps? And can it be done? Should our reserves be helping towards fund that side of the growth of India, rather than just having reserves? Because if reserves are reserves, and if you get sanctioned, it doesn't really matter.
Yeah, they don't. And last couple of questions, because I understand it will be a busy morning for you. One of them is on this piece of semiconductors that you're bringing out. I was reading some information this morning which said that because palladium and neon, two resources which Russia produces some 40% of palladium and Ukraine produces some astronomical amount of the world's global supply of neon, and therefore are we looking at another semiconductor shortage? Now, my question therefore is that if there is indeed a belief that there is an acceleration towards EVs, if there is an issue of semiconductors, then is the narrative around autos looking slightly wobbly? A lot of people are of the belief that after years of underperformance, 2022 could finally have been the year for autos. Is that at the question mark now?
Yeah, I think, listen, it's facing, the auto sector is facing multiple headwinds, two of which you mentioned. And of course, if we're spending more of our money towards our energy and food bills, then, buying a new car is probably not, one of the things that we're likely to do in the very short term. But, that deferral of purchase will probably make us look more and more towards electric vehicles going forward. So that's the positive side of it. But in the very short term, you're walking up and down an escalator. There's too many headwinds at the moment for the auto sector to kind of overcome. Now, it will be kind of oversold to some extent, and you'll get that that kind of move back up if things are stabilized. But otherwise, it's a sector which, for the time being, you should avoid.
Okay. And my final question is on the two spaces that are in the thick of action right now: energy, upstream, oil upstream, and metals. Now, various kinds of reports coming out, some saying that based on their calculations, the upside in gas prices that happens now every 6 months, and oil being where it is, forget being the spot price, but even at 100, there is some substantial upside. I think JP Morgan said that they believe UBS said 100% upside for ONGC, Oil India, and the likes. Morgan Stanley today said Reliance, they are an overweight, and everybody and their aunt is upgrading the likes of Hindalco and some of the others. Where are you on this argument of commodity companies, both upstream oil and metals, at the current juncture?
So, Niraj, it's more of how you view the conflict. To be honest, if you expect it to be more prolonged, more difficult, and more sanctions coming, then obviously these two sectors which you've talked about will continue to enjoy kind of that money move towards it, because that's where you can see obviously earnings growth and everything else compared to the rest of the market. My view is that if you remember in 2007, oil price went to 140, if I remember. And then, we had the financial problems in 2008. At some point, demand destruction will come in because of higher oil and commodity prices. So, if anything, I'm looking at when these sectors should be sold, rather than thinking. I mean, it's more trading to my mind, because you're trading on a conflict. You're not trading on the fundamentals of the company. And once that turns, these prices will fall very, very quickly.
Got it. Okay. That point is very well taken. Andrew, Holland, I really appreciate you taking the time out today, and some nuggets of information, nuggets of thought process. So thank you so much for all of that. And
pleasure. Thank you.
Viewers, thanks for tuning in.